today's turbulent market environment, it is becoming very hard to find the effective asset allocation solution. We know that markets are unpredictable in nature and stock prices are random in their behavior. We also know that market risk factors can never be totally eliminated. In that regard, will 2011 mark the return of market risk? And in that case, what is the most dynamic asset allocation strategy for the medium term? Let's welcome Jean-Yves Dumont, Head of Asset Allocation Strategy at Dexia Asset Management, who has kindly accepted to share his views with us today. Hello Jean-Yves and welcome.
Hello Michelle.
So Jean-Yves, we are at the beginning of the year. Just a few words on the current economic climate. Do you think that 2011 could be volatile?
For investors, the perception they will have about the macro will be volatile, as there are still three main risks: tightening in Asia, expected tightening in US if we still have good economic figures like in recent months, and the impact on growth about all the austerity measures we have in Europe. Our base case scenario is a soft growth scenario, low inflationary pressure, sustainability of growth is there. So the uncertainty about that will be eased, and that's a good thing. We think that all in all, the macroeconomic context for the global world will be good.
In that context, what is Dexia's asset management strategies in terms of diversification and asset allocation?
We like risky assets, like we did in 2009 and like we did in 2010.
And you're happy about what happened during the past years on those risky assets?
Yeah, of course, and we still continue to overweight those risky assets: equities, credit, high-yield bonds, emerging bonds.
You mean that all the risky assets are yielding positive results?
We think so, and for several reasons. Macro, we talked about. Valuation are not expensive. We still have good earnings dynamics. And for equities, for instance, we've got a thematic about the M&A wave that we expect for 2011.
So let's now move on to emerging markets, which, as you know, have been always regarded as highly attractive. So do you remain overweight in emerging markets?
Yeah, we play that theme across several asset classes: equities, emerging bonds, government bonds, and corporate bonds, for several reasons. Stronger growth than in other regions, and for the forthcoming years, this growth will be less dependent on exports, and it's all about domestic demand growing. Valuations are not expensive. We still have massive inflows to come into those regions. These are structural matters, and we think that it's going to continue. Some people say that it's the end of the emerging markets outperformance. We don't think so. Okay,
but are there any risk factors that might affect emerging markets this year?
Of course, inflation. A mistake of monetary policy is still possible, so we monitor that very closely. They proved in the past that they could monitor that, so we trust them. You've got a too fast appreciation of emerging currencies. That's another risk. Then you've got valuation. If you have a massive rally in emerging market stocks, you could have a problem with valuation. Political instability. Those are still emerging countries, even if some of those countries are developed countries, as I would say. But there's still a risk of political instability and liquidity. Because those remain satellite holdings in most global portfolios. So fund managers at one point, when there is a crisis, they cut the most satellite bets.
Right.
And liquidity can dry up in a few days. So that's another risk.
So you know how to manage all those risk factors.
Of course.
Okay, just a few words to conclude maybe. How do you expect investors to behave in 2011?
2010 was a year during which risk appetite varies a lot. We expect that to remain, but at above average level. We've seen in recent weeks that risk appetite was back, and we expect risk appetite to stay for 2000. Yeah, of course. Then it's going to be a tactical year again. So I encourage investors to use breadth and sentiment, short and medium-term indicators to play those risk-on, risk-off periods.
Right. Jean-Yves, do you have some figures to share with us quickly?
For spread products, we expect between 4 and 6% of net return, so for corporate investment grade, for high yield, top of that range. We expect 8 to 10% for equities. We also like alternative investments. We expect 6.5% of total return in this area. Alternative investments for two reasons: more dispersion of performance in 2011, and of course there are now fewer players, and fewer players mean more arbitrage opportunities. So that's an asset class we should look at, definitely.
Well, Jean-Yves, thank you very much for coming.
Thank you.
It's no secret that asset allocation relies on what investors call diversification. A globally diversified allocation harnesses the power of markets and manages the balance between risk and return. Thank you for your attention, and goodbye.